September was an eventful month for the fixed income markets. Global rate easing cycle gathered more steam, with US Fed starting its rate cutting cycle with a 50 basis points rate cut in September. Given the inflation in US has cooled off and rates are still elevated, there is an expectation of further rate cuts by the US Fed. The dot plot, which indicates FOMC members' projection of future interest rates, indicates cumulative 200 basis points of rate cut over the next 2 years. Back home in India, the RBI left interest rates unchanged in its October MPC meeting, which was last week. However, there was a significant change in the stance. So the policy stance is now changed from withdrawal of accommodation to neutral. And this is seen as a dovish shift in RBI's policy. It has opened a door for future rate cuts. Now, provided there is no new price shock, we would expect RBI to kick off its rate cutting cycle from December onwards, with a maybe 25 basis points of cut in December policy itself. Cumulatively, we are expecting 50 to 100 basis points of rate cut in this cycle, which may last for next 1 year maybe. On the fixed income market, bond yields across the maturity curve came down by around 10 to 15 basis points. The 10-year benchmark bond, benchmark government bond, for that yield came down from 6.88% to 6.76% during the month. Corporate bonds also witnessed a similar kind of drop in yield, though at the front end, 1-year rates moved up slightly, which was contrary to other parts of the curve. In the money market, the divergence between the treasury bill rates and the CP/CD rate that actually widened further. This divergence has been for some time because treasury bill issuances have come down. So first in the budget, government reduced the supply of treasury bills. And then in September, 2 of the treasury bill auctions during the last weeks of September were cancelled, which kind of reduced the supply further. While the issuance of certificate of deposits picked up as banks have been looking to raise more deposits because of the gap between the credit and deposit growth. We expect this gap to persist, this divergence to persist for some more time as the pressure on the deposit side continues. Now, on the outlook, near-term bond market will continue to follow or take cues from crude oil prices or the global yields and all the news flows. Particularly the geopolitical situation in Middle East is a key risk for the bond market in near term. However, from a medium-term perspective, we maintain our constructive view on the bond market. Our positive view is mainly supported by a structural shift in demand-supply balance in the bond market and a cyclical turn in the monetary policy cycle, interest rate cycle, you can say. So on the demand-supply side, given the government is looking to reduce deficit and debt, supply of bonds will remain limited going forward. However, demand for bond has been rising at a very strong pace, mainly supported by asset growth of insurance companies and pension and provident funds in India. Also, India's inclusion in the global bond indices has added to demand for government bonds from foreigners. Another factor which can add to demand for bonds is RBI's proposed norms for proposed changes for the LCR norms. So given those changes, banks will be required to hold more of liquid assets, primarily government securities. So that can boost demand for government bonds from banks as well. So supply is falling and demand is rising. That's a very favorable backdrop for bonds, and bond yields are expected to go down because of that. Also, the monetary policy cycle is changing, as I discussed. It's changing globally, including in India. It is expected to turn where RBI starts cutting interest rates. So as yields go down, that is good for long-term bonds. It appreciate in price, and long-term or the debt funds which invest in long-term bonds, they gain in this kind of environment. For investors' perspective, I feel they can choose dynamic bond fund if they have a longer holding period of say 2 to 3 years. If you have a shorter holding period and low risk appetite, it's better to stick with very short duration fund or liquid kind of funds. So that's all from my side. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.